Thank you, everyone, for joining us today. I'm delighted to be joined by Dave McCarthy, the Executive Director of Potential Energy DC, and he'll be talking about what it means to dilute yourself and your investors.
Thank you very much, Lynn. I really appreciate you bringing me in.
We wanted to go over a few quick reminders before we get started. If you have not yet completed our CEBN member questionnaire, please do so by next Thursday, the 21st. We're up to 114 responses, and we are doubling our original goal to 200 participants by next Thursday. Additionally, tonight, if you're located in the Washington, D.C. area, there is a live event that's somewhat related to the topic of today's webinar. There is a panel at the Cornell Club with some expert advisors on law, finance, and business advice for startup companies, and it's only $5 for non-members, so please stop by that if you have time. And then finally, you should have received in your email reminder about today's webinar a link to download an Excel file that Dave will be showing during the webinar. You can also click here on your screen to download it, but if you do not receive it, then no worries. We will make sure that you do receive that Excel file when we send around the recording and slides to this webinar tomorrow. So with that, I'd like to introduce Dave McCarthy, the Executive Director of Potential Energy DC. I'll let him speak a little bit more about the organization, but it is a 501c3 nonprofit organization that serves as the only DC area incubator fully devoted to developing energy, efficiency, and sustainability companies. So Dave is actually an engineer by training and has successfully run his own startup companies at runfast.net, which is an online multimedia training company, and Windrose Media, a webcasting technology and original content development company. So Dave will tell you a little bit more about his organization as well as the topic of today's webinar.
Into a little bit more detail about Potential Energy DC, we are the region's only incubator devoted to energy and sustainability startups. And our plan is eventually to take over the world. So we're planting one here in DC, and there might be a Potential Energy coming to a region near you soon. So be on the lookout. As Lynn said, my name is Dave McCarthy. I run Potential Energy DC, and I also have my own consulting practice where I do things like we're doing today. So running workshops, training, and then also helping startup companies with the raise process itself. And this workshop that we're doing today really feeds out of that consulting practice as much as anything, where the notion of like what really happens when we do our first raise to the entrepreneurs, the entrepreneurial team's equity position, and then furthermore, what happens to in the second round, what happens to my investors' positions once I bring on another round of financing, and all of that math is really kind of murky. And so this workshop was born out of the murkiness of that math. So if you don't have the Excel workbook up in front of you, I'd recommend go get it now. If you don't have access to it, don't worry. We'll get a copy of that out to you shortly with the recap of this session. But what the Excel workbook does is try to demystify that math around pre-money, post-money, dilution, my position, your position, and all of that. So with that as a little bit of background, why don't we talk about what I'm not as well. Based on this 1 hour we have together, I'm not your attorney, I'm not your tax advisor, neither is Lynn or Andy here in the room with me. All of these topics need a lot more detail and a lot more complexity worked through, so please don't consider this any specific advice or legal advice or tax advice. These are very complicated scenarios that we're very much simplifying. So I'm not a member of the ABA either, but I do recommend you getting engaged with an attorney or CPA at some point. All right? So what are we going to do today? So giant disclaimer out of the way. We've introduced ourselves on this end. We're going to go through what I like to use metaphorically as the cake. And so you'll hear it referred to as the stack. But it basically gets to who owns what in your company and how much of it there is. And we'll go through 3 stages of that. What the stack looks like at startup, what that stack looks like after you might get an angel or a seed round in. And part of me, if I use those terms interchangeably, but seed rounds are usually funded by angels, so I kind of use that interchangeably. And then your A round, which is typically first outside professional capital, institutional money coming in. So we'll kind of run what happens to your stack through those 3 different stages. And then at the end, we'll do some extended Q&A because this is a fairly complicated topic, which can have some complicated questions. So we'll run through that. Now that I've given all the disclaimers, what can you really expect to get out of this? So the first thing is really just to generate an understanding of what it means to dilute an equity position. So you have a slice of the cake that you own. What happens when you put another slice on, and what does that mean to your position? The second thing you should walk away from here is the analytical framework and basically the real basic calculations about how to figure out what does happen to your position. And then the third thing, and this kind of depends on you, but the more you know about what's going on in your company, the number of shares that are authorized, the number that you own and your team own, a real specific understanding about what's happening within your company specifically. So now to the heart of the cake here. So when you start your company, there's something called authorized shares. And it could be an LLC where they're called units, could be a C Corp or an S Corp where they're technically called shares. But your authorized shares are the total number of shares that are available in the company. So when I started my first company, RunFast, we had 10,000 as the number. When I did Windrose Media, we were an LLC and we had 10,000 units. So whether it's an LLC or it's some form of a corporation, there are an authorized number of units or shares. And that's the whole cake, baby. That's all you get. That's all you can play with unless you want to add some more, all right? The nice part is, guess what? They're all yours. You and your founding team own the whole cake, right? You and your team can figure out how to divide that, and that's another entire workshop. But at the beginning, they're all yours. So the dreams are big. The exits are in the tens of millions, and we're ready to roll here at Startup, all right? So if you have them available, or you can just make up some numbers, get out your founding documents. So in my world with RunFast, I was a Virginia C Corp, so at this point I would have been getting out my Virginia State Corporation Commission authorization, and I would have seen that there were 10,000 shares available. So this is simple. So let's take a look at, I'm going to click over to the spreadsheet now. So I'm going to go into Excel and look at the first tab. So the first tab is what your stack or the cake looks like at the startup of the company, all right? In this case, we'll run through a company that has authorized 10 million shares, all right? The bad news is they're not worth anything because the company's not worth anything. So your valuation is 0. Typically, and again, this is going to get into some of the complexity that I'm going to leave aside. Technically, you can't really do that. So you'd probably set a par value of 1/10 of a penny or something like that. But for all intents and purposes, the company's really worth nothing. Now, also, in this example, we're going to say that we have set aside 6 million of those shares of the initial 10 million as founder ownership. So those are set aside for you and your co-founders, and you own that portion of the company. The portion of the company that is actually owned by somebody is called outstanding. So then you have your authorized shares of 10 million, the outstanding that you and your founders own of 6 million, and then there's another thing called authorized but not outstanding, and that's everything that is authorized to be sold off at some point, but isn't sold off yet. So nobody owns them, but they're kind of out there and you're allowed to sell them off. And of course, we're dreaming big here at the beginning, right, at startup. And so our exit valuation, we're going to say, is going to be 20 million, right? And that's awesome because we own all of the outstanding shares. So we as the founders get all 20 million. Well, sort of. There's going to be transaction fees on the front end and on the back end. You're going to pay your attorneys, you're going to pay your CPAs and all of that. But generally speaking, you own all 20 million of that exit, all right? Simple, right? All right, so let's go back over to our PowerPoint and see what happens when we start to bring in some outside money. So that was startup. We went through authorized and outstanding. And so our founders' ownership was 6 million, authorized total of 10 million. And 4 million on the top, sort of what I'll call headroom for another 4 million of shares that we can sell at some point. All right, so now we come in, we have, let's say, we've put our concept together, we've founded our company, we've figured out how we're going to divide up our initial ownership, we've done a really, really good job with our lean startup, we have, determined our business value, we vetted it through our potential user and buyer communities, and we've gone ahead and we've developed our go-to-market minimally viable product, all right? And we've gotten some traction. So we're being successful here, right? This is very similar to what happened at RunFast. In that case, we developed the first ever online OSHA 30-hour construction safety course for construction. So developed the first product, got it out to market. We went through all of the minimally viable product. We said, wow, this is good. We're now getting some traction. We need to scale this business. So we went from one very small region of the company, and if you can picture the construction business, it's very regional generally. So we got money to then hire some salespeople to start blowing out that first region that we were actively engaged in. So we said, went out to, I would include friends and family in this, but we went out for about a $1.5 million total raise. That's a little large for the seed size. Usually it's on more of about a $500,000 scale. So in this case, for our angel analysis on this one, we'll say that we are going to go out for 1.5 million shares of the company. That's going to sit on top of the 600,000 or 6 million, that we've already that we have as owners. So we're going to take 1.5 million of that 4 million not authorized or not outstanding, and we're going to sell that. All right. So let's click over to our spreadsheet and our seed round analysis. This gets a little hairy, so start typing questions if you need any clarification, all right? So we're going to say that based on the traction we had in the company, we're going to say our company is worth $1 million for our seed round. Given that valuation, there were 6 million shares outstanding. I'm going to start using my mouse here to circle the cells that I'm talking about, all right? So it's $1 million valuation pre-money, 6 million shares outstanding. That means each share is worth roughly 17 cents. Now, we're going to raise $250,000 here. To do that, we have to sell 1.5 million of those shares at that rate. I'm going to click into the cell so you can see how these calculations are working. So if we want to raise $250,000, we're going to have to sell 1.5 million of them because they're valued at 17 cents each. So you see how that math works, all right? And then I just like checking myself here. All right, so that's the right proportion. So then after we do our seed round raise, the company was worth $1 million. We raised $250,000. So now the post-money valuation is $1.25 million. And again, this is a little oversimplification, but just kind of run with it on the math for now. And then also after the seed round raise, there were 6 million outstanding. We sold 1.5 million. So now we have 7.5 million outstanding. All of those things are valued at 17, roughly, cents a share. So cool, look at us. We built our product, we did our MVP, we got it out to the market, we convinced some angels to put $250,000 into the company. This is awesome, we're entrepreneurs, right? Well, let's scroll down to the bottom of the spreadsheet here, right? So if we said that we were on track for a $20 million exit, that was going to be all ours at the end, right? Well, look what happened. We just sold a bunch of the company off, and we only then own, post-money, 80% of the company. So we're owning $6 million out of the $7.5 million that are out, so we own 80% of the company. Well, if we're still selling at $20 million, look what happens. We're only getting $16 million, minus attorney's fees, CPAs, and everything else. Well, that's not fun. Everybody likes to make less money. And believe me, these raise cycles are hard. They take a lot of time, a lot of money. You're probably going to have to give up board seats. And so there's a lot of pain behind these things, too. I'll keep it clean for now, all right?
So if you have the spreadsheet up in front of you, let's play with that valuation number a little bit to see what needs to happen to the valuation of the company, the growth path of the company, just to break even to get back to our 20 million. All right, so if you have that spreadsheet open, go ahead and start clicking some numbers in there. I'm going to click some numbers in here. So it's not 24 million. I know the answer. So now, if we're going to go ahead and get that angel round in, that money needs to be used to make the company grow even more than it would have without the money in it. It kind of makes sense, right? But these are the numbers you need to have in mind. No longer are you trying to manage to a $20 million exit. You need to manage to a $25 million exit just to break even, to get yourself 20 million at the end. So, like I said, this stuff can be a pain. It can take a lot of time. You're going to have to give up board seats and some of your control. So when you want to exit after that, you should up your expectations for what that exit is too. So now, really, your valuation, you should be looking at least a $30 million valuation to make it worth your while to go through that angel round raise. Believe me, I'm going to say it a third time in this one section, it's a pain, and you're going to have to give up control of your company. So if you're thinking about it, all of a sudden you were planning a $20 million exit, you've just upped that by 50% by taking in this outside money. Not that I want to dissuade you from it, because then you may end up making more money and grow the company, employ more people, increase the tax base, and all these economic development things that happen on down the road, and you make more money. So that's your angel round raise. So we'll click back over to our PowerPoint. So now we have the founder shares that are out, and we're up to 7.5 million outstanding, and we still have another 2.5 million on top of that. So now let's go to our A round raise. So we're taking in a second, actually, Lynn, do we have any questions that we should take on here?
This is actually a really good, a good question. It's a good time to ask it. So how can the founder justify the logic of increasing valuation? And is valuation at a point in time a function of cash flow, growth rate, et cetera? So,
So let me hit the first topic of valuation. So valuation of either a pre-revenue or a very early revenue stage startup that would be going for an angel round is very hard to determine. So there's usually no good math to do it because valuations are typically on cash flow, on revenue, or on sales. Sales and revenue are different. So it's very hard at those early stage companies to define a valuation. The best thing that I would advise people to do is to agree with their investors on a method for the valuation. And so the best thing that I would advise on that then is to look for comparables for companies in your space that are doing similar things and what they were valued at their early rounds. So I'm working right now with a battery technology company, for instance. They don't make the batteries, but they make the control software for the batteries. There was just a recent, fairly high-profile exit in the region here. The company that did the exit was called Greensmith. And Greensmith had just north of 100 megawatts of batteries under management. So 100 megawatts. They sold for around $200 million. So it was roughly $2 million per megawatt of storage under management. So now that I'm working with a very early stage storage startup, we at least have that $2 million per megawatt under management bar to begin the valuation discussion. So I'd recommend that if you are in the HVAC controls world, or if you're in the building automation, find other companies in that space and look for what those recent exits have been. And they can't be in the billions of dollars because you're not a billion-dollar company, right? So look for something fairly early stage that's gone through a seed, an A, and a B possibly, and they're now exiting. And find those case studies and see what their valuations are based on. And
at least have the discussion with your investors about what is the process going to be by which to value this company, because you're going to lose the discussion on cash flow or revenues because you're early stage by definition.
Okay.
All right.
And are there any recommendations for sources for establishing that yardstick by which you can measure your...
So Crunchbase is a good one. A friend with Crunchbase is even a better one. It's not cheap, and usually, I mean, somebody in your network probably has access to it.
Okay.
Unless you're, I don't want to. Is there anybody from Crunchbase online?
I don't think there is.
Don't get in trouble. Yeah. So Crunchbase is a good one. That's probably the best one. That's one I use. Also, in the region here, Fairfax County Economic Development Authority tracks all of the venture deals in the region. And so if you know somebody over there, Rodney Lusk is a good person to talk to, or Ann Rosenblum is also tracks all of them. So
that's a good suggestion, since many communities do have those economic development authorities. That could be a source. So I just had a question. Again, what is the website that Dave just mentioned? It's Crunchbase.
Crunchbase. Yeah. And AngelList is the other one that I couldn't pull immediately. Okay. AngelList is another good one.
Great recommendation.
One thing I would not go to is any crowdfunding sites. They're just, valuations are very hard to really track through those things. So they're great for product launches if you want early cash flows before you actually produce the product. But for raising equity, they're hard to pin down. All right. Okay, so let's say we've been really successful now. We've had our software product in the market for probably a year after our seed round, and we've captured our regional market. And now we want to go multi-region, or maybe blow out multi-product from the product line. So either regional expansion or vertical expansion, or maybe some sort of horizontal expansion. But you're ready to kind of expand an existing business that is probably either cash flow positive, like just tipped cash flow positive, or you're on the cusp of it. That's usually when the first institutional money, kind of the A round, is going to get involved. And so before we dive into this is where things are really simplified. You know, your startup and your angel round or angel seed round are pretty simple. Once you get into your first outside money, things are going to get very complicated. And this is a very simplified version of it. There are lots of good books out there. One is subtitled How to Be Smarter Than Your VC and Your Attorney. That book is really good and goes through a lot of the complexities about how to negotiate your A round. So highly recommended that. All right, so then getting into our A round analysis, one other thing that usually happens at your A round is you're ready to expand your headcount in your business. And there is usually a set aside for your employees' option pool, and that can be anywhere from 10 to 20%. I'm just kind of leaving that out of the analysis for now, because that's a big chunk that's going to impact your numbers and your, the portion of what you own. But again, that's sort of being left out. Okay, but so let's assume then that we're going to raise, so we're going to go multi-region now, or multi-product line, or maybe multi-vertical, and let's see what happens to, the numbers. All right, so we went from startup, we went through our seed round, angel round analysis, and now let's look what happens to our, at the A round. So again, we're assuming that we've been incredibly successful. We capture a nice chunk of the market share in our region, and the company is now worth $6 million, all right? That $6 million is represented by the $7.5 million that we ended our last round with, right? That was our founder capital plus our seed round. And so look what's happened to our share price. We've gone from roughly 17 cents a share. We're now selling at 80 cents a share. Great news, right? Absolutely. So now we're going to raise some more money to probably hire sales and marketing, a little bit more support, because now that the product's been successful, you need to support your users. So we need to go back for another raise to go multi-region here. And so to raise that $2 million for our business plan, we need to sell 2.5 million shares at 80 cents a share to get there. All right, so again, I'll click in the cell to show the math. So we're raising 2.2 million. If it's 80 cents a share, we are then have to sell 2.5 million shares, basically everything that's left in the company. And then post-money, again, this is a little bit of an oversimplification, pre versus post-money, but you start at $6 million, you put $2 million in cash in, you end up with $8 million valuation for the company. We went from 7.5 million in shares, we sold 2.5 million, and now we're fully diluted, and that's an important term to know. When you've sold all the shares you can sell, you're fully diluted. We've sold all 10 million shares originally in the company. So then, dilution-wise, let's look what happens to the percent ownership of each of the different rounds now, all right? So the original founders still own the 6 million shares that we started with. That represents only 60% of all of the shares that are out there. So we only own 60% of the company. Our angel round got diluted too. Let me click back one. So we were at 80 and 20 after the angel round. We're now at 60 and 15 after our A round. And our A round, First Institutional Money, now owns 25% of the company. And there's nothing authorized but not outstanding. We've sold all of the shares of the company. Don't panic, you can always add more, and it just works. The math basically works the same way. But, all right. So all of that is sounding pretty good so far, but then let's go back down to the exit again and see what happens. So originally, when we were founders and we owned the whole cake and the sky was blue and the sky was the limit, we were picturing a $20 million exit. Well, now, if we still plan that $20 million exit, only owning 60% of the company, we're only getting 12 where we used to get 20, right? And so after the angel round, we said, well, that needed to be at least 25. And then we said, well, to really make it worth our while and all the pain of doing the raise and giving up control, it really should be more like 30. Well, now this is 2 rounds of raising, 2 sets of outsiders controlling our company. Take a second to play around with what that valuation needs to be at exit. From one point of view, just to get you back to the 20 million. Then the other point of view, what is it worth for your pain and suffering of having to deal with attorneys and investors and board members and quarterly reports and cash flow statements to other people and people checking your math and everything else. So just take a second to start playing with that number. We started at 25 million. Oops, that would be a nice exit, 250 million. One too many zeros. So even the 25 million is not getting us back to where we were. So is 30 even getting us there? Nope, got to go higher than 30 just to break even. So you're looking at just under 34 million in terms of accelerated growth path just to break even. Now again, 2 rounds of raising can be practically humiliating. 2 more sets of board members telling you what to do and double checking your math. You're probably, for all of that hassle, want to get to 50 million. Again, that's to get you to a cash out of 30 where it used to be 20. So maybe it's even got to be bigger than that. So before you raise, I would come back to this spreadsheet and start playing with the numbers and what are you going to do in your A round, what are you going to do preceding that in your seed round, and how much pain and suffering you want to take on to do the raises and deal with additional board members. So it can get kind of complicated. I mentioned that book, Being Smarter Than Your VC and Your Attorney. That goes through preferred preference and all these other, and plus when you sell the company, it just doesn't flow right back out immediately. Everybody wants to take their chunk and things like that. So it's a complicated process at the exit as well. Any questions, Lynn, based on math? All right.
Yeah, one of the topics, I'm kind of combining a couple of similar things that have come up, is which of these decision points do you actually have control over? Which things are fungible here? So,
sure.
I mean, some of the clear pressure points are the founder's ownership goals, what your cash out goals are. What are things that you actually have control over if you're starting out that you can determine,
sure.
Whether you want to pursue these rounds of investments or not?
Well, all of it. I mean, you and your founding team own the company. So nobody can come by and say, here's $1 million and I want a piece of your company. It's your decision as to whether or not you're going to bring on this type of money. The thing that I would strongly recommend is if you are going to bring in outside money, it is very clearly tied to some kind of tangible milestone. So the last A round that is actually a seed round that I participated in as an angel investor, they were pre-revenue. They had one demo client, and it was a very big risk, but they needed money, and they needed to re-platform their demo system into an AWS multi-tenant SaaS bulletproof platform for that first client, because that first demo client said, yes, we want to buy this thing in real life now. And so they were like, oh God, okay, we're going, this thing's real. And they needed some money to do that. So in addition to re-platforming the system on bulletproof AWS cloud services, they tied to that money coming in to sell 2 more clients, get 2 more logos on the board, and then get to $715,000 in sales that year. So this was 2016, a year ago that we did this deal. We put the money in tranches, so we put in roughly 150 in February, 150 in March, and 150 plus in April. And what happened was they re-platformed the system, they converted the initial client, and they got to 691 in revenue for the first year on a target of 711. So they got more than 90% of their sales target done. So we declared that a huge victory. So this client in particular was landing in the Northeast and expanding in the Northeast region. So they've been busy at that all this calendar year. So they just crossed $1 million in sales for this calendar year, and they're going to try to get to $2 million this calendar year. So that's going to set them up for, very similar math to what we're looking at here for an A round to then go multi-region. So they had an anchor client in the Northeast. This next round of money is going to try to get an anchor client in the Southeast and an anchor client in the West. So at that point, they will hopefully be making very good use of that money, hiring salespeople, more support of a support team, and also a little bit more development resource.
And I think the example you raised actually gets to another potential consideration, which is, so you want to balance the risk of diluting equity in your company, but at the same time, you also need to get to the exit. If you own the entire cake, but your valuation is 0 at the end of the day, so you have to kind of think about what investments you need to actually make your product viable and successful.
Yeah, exactly. So when you're taking in that money, it's got to be tied to those milestones of, and I use the term stair-stepping up your growth path. It can't just sort of tilt the line a little bit. It needs to take it on a new trajectory if you're going to bring that money in. Otherwise, you can see what these things look like at exit. It's not worth it, right? Unless you're really going to stair-step up that growth path, it's not worth taking the money in. And, again, there are very natural points at which you would take in that money. When you have an MVP up in the market and you need to flesh out the product itself and the salespeople, generally investors like to see money applied to a sales team because that means the product's already done. And, from an entrepreneur's point of view, you want to push that money as far down the path as possible, because the more traction you get, the more clients you get online, the more products you get into the market, the better your valuation is going to be, and the smaller piece of your company you're going to need to sell for the same amount of cash infusion. All right? All right. So let me reiterate, these are very simple spreadsheets, and I think I sort of gave away my last line on the last slide. But the real life doesn't look like that nice, pastel-y colored cake with nice white frosting in between. Real life looks a lot more like this slide. It's kind of messy. There's preferred preference. There's follow-on rights. There's pro rata rights. There's all these different things that kind of come in and mess up what should be a very simple process. So let's give you a little view into a spreadsheet that we have for an actual an actual round that we did. So this was actually the company I mentioned that landed in the Northeast and began expanding. I mentioned the 3 tranches of money that came in. Those are SPOR 1, SPOR 2, and SPOR 3. So that's what's represented with those. There were 3 separate LLCs that were used to pool Angel's money into a single entity that then signed an agreement with the entrepreneur to make the investment. Because sometimes what happens is every angel that comes in wants slightly different terms, and so your entrepreneur is signing 10 different notes, each with slightly different terms, and it's an administrative nightmare. That's one thing that leads that nice cake to look like a chocolate mess. So you want to keep a really, really clean cap table, as it said. And one way to do that is to pool your investors into a single purpose entity and have that SPE actually sign the paperwork with the company. A couple of underlying things there is that your investors have to get along with each other. Otherwise, they're not going to want to be in the same LLC and be in the same business together. But as long as they're pretty close in terms of what they're expecting for terms, and they can at least get along with each other, I would really recommend you follow this SPOR model of putting together an LLC, all of your angel rounders put their money into that LLC, and then it's the LLC that signs the investment document with your entity. Keeps the paper, for one thing, is that it keeps the transaction costs way down. So you're not signing 10 different notes, you're not signing 10, putting out 10 different term sheets. There's one term sheet, there's one agreement, there's one LLC. It keeps the transaction costs way down. All right. And then let me just kind of scroll down here. So some assumptions at the top first about what the valuation is going to look like at the exit. Trailing 12-month sales contract at the exit is what we're using as our basis for our SaaS valuation. They're already pretty close to this. They might hit $2 million this year. So, we might push a little bit further and try to get to 4 or 5 trailing 12-month sales contracts. The typical SaaS valuation on contracts is between 4 and 5. Some of these you'll see in the 10 to 12 range, which I think is kind of crazy, not knowing the details of them. But so we're going kind of conservative. We're going to say, a 5x on trailing 12-month sales. Series A valuation, Series A money. This is kind of the spreadsheets we just went through. Don't worry about year in, year out. That was to track kind of portfolio IRR later. But then here's some real numbers about what we did with this company. We pooled SPOR 1, went in. We had commitments for SPOR 2 and SPOR 3 before we even started. The valuation cap is very important. So we were talking earlier about how do you value the company for a startup looking to raise. A convertible note or a SAFE agreement are good ways to kind of kick that valuation down the path, where in a SAFE or convertible note, the money that comes in now is actually valued according to your A round and gets the same terms and conditions as your A round. What we did in this case specifically was the first money that came in got a 33% discount to that A round valuation. So the first round that came in is getting a pretty sweet deal here. So we had a valuation cap of $2.5 million, which is then also discounted by 33%. So the company had 10 million shares. The converting price is 25 cents a share, assuming fully diluted. 10 million shares, 2.5 million valuation. Then you can see for SPOR 1, they're getting a discount on that share price for having been the first money in. Then through the magic of math, we can figure out how many shares were purchased, the pre-money percent of the company owned, right, just like we were talking about dilution. Then we talked about the Series A valuation, the pre-money. So the most important 2 lines in here between 18 and 25. So again, this is a real live example of what happens to your seed round investors' position when the A round comes in. SPOR 1 is going from 6.36% to 5.09%. And this was done on the investor's behalf, so you need to do the other side of this for yourselves too to see what happens to the entrepreneur's side of this thing. But another important line back at 18, you can see that there's a significant, and you're talking about when to bring in money. So for that, was that 530 total that came in, they were giving up or selling 23% of the company. So that's really, really important. The further out you can push that raise, the smaller that percentage is going to be over time. Now, you can say, well, Dave, you're a vulture capital for taking 25% of that company for $500,000. Well, you know what? They had no revenue, they had one demo client, and they needed a lot of money to get that thing going the first year. So that's kind of the other side of the table speaking, right, from the investor side. This is very high-risk money. Granted, they're doing well, they've done well in the Northeast, but we're still a long way from an exit. And then you can see, too, of how we get diluted. After that A round, we no longer own 23.36%, we own 18.69%. Let's get to the exit. Let's assume everything goes well. We've done our seed round. We do our A round. Money comes in, post-money valuations. We exit. We're looking at $2.5 million of recurring revenue on a SaaS valuation of 5. These were the valuations I put in up top. So the cash-out value of the company is $12.5 million. Spore One owns 5% of that. They're going to cash out $636,000. So that's a multiple of 6x. The other two spores are going to get a 4x. And again, I don't have the entrepreneur side on here, but go through the calculations at some point for your own company. You don't need to do it for this case, but do it for your own company and say, okay, well, what would I have gotten? I would have gotten the $12.5 million, but now the entrepreneur owns less than 100%, right? So you need to figure out what's the right mix for yourself of taking on money now, taking on money later, what it does to your percent ownership, and what does it do to your exit. Then if you scroll down even further, more detail, the last one is the potential payouts for each of the angels that participated in those rounds. So angels 1 through 10 are the people that participated, anonymized, in the initial angel investing here. So I won't tell you which one of those I am, but hopefully we're going to make a lot of money for our entrepreneurs and ourselves. Any questions based on that? Because that is a lot of numbers and a lot of spreadsheeting, but it is a very tangible, real-world example about dilution, focused in this case on the angels when they come in, going from, you see from, 23.36 to 18.96 when that A round comes in afterwards.
Yes, kind of going back to your early stage assumptions, and you talked a little bit about, ways of valuing the company pre-revenue, but so imagine, some of these folks are going into their Shark Tank pitch. Yeah. And it sounds like ideally you would like to try to get your valuation, your exit valuation up as high as possible, and your pre-revenue valuation, that's going to be a critical factor in determining the price. Obviously, the higher that can be, the less you can give away with raising more money. Yeah. But I'm wondering if you could speak a little bit about some of the assumptions that would play into those valuations and, what data that you can present to help justify bringing it up as much as possible.
Yeah, I mean, the number one thing is going to be the quality of your team. There is no doubt that when you walk into the room with a potential investor, the first thing they're evaluating is the quality of the team. And, here in the D.C. region, there are a lot of smart people, a lot of engineers. I'm one of them. Well, I'm an engineer. I won't say how smart I am if it's up for debate. But a lot of engineers that like to do things on their own. They're great numbers people. They're good product developers, and they try to do everything themselves. I strongly recommend not being a solopreneur if you're trying to grow a business. If you're running a pie shop, great. If you're running a food truck, fantastic. But once you try to build a business that's going to scale, there's just simply too much to do to be a one-person shop. So straight out. If you're one person, don't go try to raise money because I don't think you will, and B, you're serving too many masters. I don't think you're going to be successful. So first thing that's going to be evaluated is the team. And if there's anybody on the team that has grown and exited a business already, that is a super double, triple gold star, great day for you guys, because that is one of the key things that investors look for. In this case that I showed with the spreadsheet, this investor or entrepreneur in particular had not been like CEO or president of a company that had exited, but he had been the head product developer for a company that had grown and exited. So, it wasn't a perfect match, but it was pretty good. He'd been through the startup cycle before. So one is team. The second thing is you need to figure out if you're one of two cases. If you are in a small-ish market, but your position in that market is really, really, really well protected. So you have great IP, or you have some kind of unfair advantage or barrier to entry that you can just protect the heck out of that market and sell 80% of it. That's one case scenario. Or the other one is it's just the market is so big, any idiot could win in it. So it's going to be a multi-trillion-dollar market, and as long as you have a hook in the water, you're going to catch a fish. So you're going to try to be one of the other of those. Best case scenario is that it's a trillion-dollar market, and you're protected, and you have a nice barrier to entry, and you can get 40% of the market or something. So it's a mix of those scenarios, but know which one you are going in, and then the other thing is know what. And it goes beyond the money, it goes beyond the company. Know what you want to get out of it, like as a person, like as a human being. What are you going to feel satisfied with in the end, and drive to that. I mean, and for sure, third is the passion. But you have to have the passion, the drive to do what you're doing. Figure out how much money you want to make, if that's your motivator, if you want to sequester carbon, or if you want to clean up the bay, or you want to do whatever, and you can just run a lifestyle business doing that, or maybe it's all of those, I don't know. But we are in the clean energy business network, so I'm assuming it's something green and clean. You got to figure out what's in it for you, and then go from there, and then start thinking about the exit, how big, how you're going to share it, what kind of company you're going to run, how much you're going to share with your employees, which goes to that employee set aside and things like that. So first thing is the team, second thing is the market. Decide what you want to get out of it, which does end up being captured in a spreadsheet. And then almost fourth sometimes is the product market fit. Because you're going to pivot. Everybody pivots. It's going to be tweaked. It's going to move this way. It's going to move that way. Almost everything is going to pivot a little bit along the way. And they want to know that they have the management team that can take the coaching, take the counseling, take the strategic advice, and being able to adapt to that product market fit along the way.
I think what you said about the quality of the team, for a lot of the companies we've encountered in our network, there is a market, but I don't know that they necessarily have a corner on this IP that cannot be replicated. So that team does sound very important. But, of course, there is a financial risk to that, too, because you're diluting the initial, you're now sharing your pool with more people, but it kind of sounds like you're saying sometimes you need to spend money to make money.
Yeah, sure. Yeah. And, from a team point of view, it doesn't need to be 10 people.
Right.
The initial core team should be 3, I think, and there have been, MIT, MBA case studies on this. I think the ideal number is 3.
Okay.
Because then if it's 2, you're just going to fight. If there's 3, you can fight with somebody, but then there still can be a mediator. And by the time you get to 5, it's too big. All right, so somewhere between 3 and 4 is probably the ideal number for a team. I run a different workshop on that's like how to build your team, and I start with your basic, business 101 org chart. Right? You have your outward-facing CEO, kind of your inward-facing president, COO. You have marketing, sales, product development, product support, legal, finance, administration on one side. In the middle, you have kind of the operational side of things. And I'll put this slide up with probably 15 boxes on it. And to any entrepreneur, I say pick 2, because you can't be the support person and the legal person and the CFO and the sales and the market, because it's too much. You have to build a team that has experience in those different areas.
That's a great point. This is a more specific question, but perfect for the slide we're on, or with the what you're showing right now with the spreadsheet.
Yep.
Can you go through a little bit more of the pros and cons of breaking down a round of investing into tranches or spores, and is it ever not appropriate
Sure.
to do that?
From the entrepreneur's point of view, you don't want to do it. From the investor's point of view, you do want to do it. It's a risk mitigation technique of, I couldn't have, but the spores could have written a check for $530,000 out of the gate, right? Say, here, Fred, Sally, here's your money, go do with it as you want. Well, that's kind of risky, right? So why not put even micro milestones in the process? Say, well, we'll put together the round of 530, but you know what? That first month, you have to show us, we're going to sit down with your clients, and we're going to vet this thing out, and, just to keep the business going. Month 2 was, okay, get your team together, sign your contracts for development, et cetera, et cetera. So it's kind of micro milestoning within the round, and it's just a matter of mitigating the risk along the way.
So the investors may be pushing you to do that, when you feel like you've got your back against the wall and your investors are calling for that. How do you know when it's appropriate for you to go ahead and agree to this?
Probably when the investors say so.
Yeah, when you got no other option.
I mean, but the upside for the entrepreneur in this case is that, one that I'm working on right now, it's $1 million seed round, and we're putting it out in 2 tranches. So it's $250,000 for the first tranche that's going to get 25% discount on the A round, so very similar to this math. Then the second piece is going to be $750,000 closed in the next 6 months. But there's no guaranteed terms. This is one of the stipulations from the entrepreneur, no guaranteed terms for that rest of that $750,000. So if he takes the $250,000 and is wildly successful and hits all his milestones with just that, you know what? Valuation has gone up on that next $750,000, or maybe they just defer it and only do an A round after that. So, that's the upside of tranching it out for the entrepreneurs, as long as you have the right clauses in the contract that say there is no definitive follow-on, there is no, it's tranched for no guaranteed terms afterwards.
Got it.
Yeah.
And some of the examples you've given, I think, are very relevant to more, IP type, software, or you mentioned some of the, if you have building control systems, things of that nature. One of the tricky things we sometimes see is if the product is very capital-intensive energy equipment. I mean, this problem has been talked about ad nauseum.
Yep.
It's all of this becomes trickier, and sometimes venture capital is just never, a great fit.
Yeah.
But I don't know if there are resources that you would recommend people look into, depending on the type of technology, to help guide, what's an appropriate level of dilution? You're obviously, the more capital you need to just make the product remotely viable, then you're going to have to give up more.
Probably. Yeah.
But, any guidance where people can sort of determine what's realistic?
Yeah, I just wrote a blog post last month on the Potential Energy DC website, plug, intentional, it's certainly in the DC region when you start talking about hardware, energy, manufacturing, deployed hardware, it's a bitter pill for early stage investors in DC to swallow. And there are probably 3, and you're probably out of kind of friends and family and out of angel round. You're going to need to get into some professional money here. There are probably 3 companies in DC, professional money, that would actually even look at a very early stage round in energy, hardware, deployed type of scenario. The best thing I would recommend for a situation like that is to find economic development money from a region of the country that is looking to expand manufacturing base. I'd also question whether or not, so if you have the patent on the technology, how much of the value chain do you really want to take on? Maybe you can just license the technology to an existing manufacturing firm is one route, is the easiest route. I know a lot of people like to build things themselves and see it grow, and the idea of licensing IP is kind of boring, but you're going to make money at it. One recommendation or to follow something like this, in the state of Virginia, there's something called the Virginia Tobacco Indemnification Fund. And what it is, during the tobacco settlements, the federal government wrote very large checks to the states whose economies were impacted by basically the implosion of the tobacco economy. And so some states just put it into their state slush fund and said, thank you very much for that $6 billion. Virginia, on the other hand, was very forward-thinking, and they put it into this Virginia Tobacco Indemnification Fund. And so that money is being invested, and the proceeds from that fund are used to subsidize manufacturing in the state of Virginia in the counties that were harmed by the implosion of the tobacco industry. And so you can go online and you just Google Virginia Tobacco Indemnification Fund, and you'll find which counties they are. The rule of thumb is $50,000 of non-dilutive grant money for each permanent job. So if you're really standing up a manufacturing facility and you got 50 jobs you're going to do, that's $2.5 million of non-dilutive grant money to get you started. But they've got to be in the tobacco counties in the state of Virginia. Now, there's something similar, I believe, and I haven't researched this fully, in North Carolina, and I know West Virginia, but it's more like a coal indemnification fund. So I would look at those pretty closely.
Great. Yeah, and I think some of your comments there about the economic development, it does speak in some ways to the need for policy, and this is one of the cases we've made for the need for federal and state investment in some of these higher risk, capital intensive technologies where there's potential societal or economic development benefits. And so I think pointing people to those resources, those are three that you mentioned that I was not remotely familiar with. We do have a number of members in our network that run their own clean tech incubators, and there's the national, I'm going to butcher the name of it, NIICE, the National Incubator Initiative for Clean Energy, which helps support a network of groups for that. So I think if members have questions about specific incubators or resources that relate to their state or region, we might be able to help direct them that way. But it sounds like this is what PEDC does as well.
It is. We do it here in the D.C. region. Like I said, we're probably the only ones that are really strictly focused on this stuff. One more plug before we leave. Our next internal project is polling all of the regional universities to pull out their intellectual property and patents that are kind of sitting on shelves in these universities that are not being currently commercialized in the energy space. So just this morning, I was over at GW University talking with their head of research, innovation, and entrepreneurship. He said, what great timing. We're just in the process of running through all of the IP that they have in the university, and he's going to peel out all of the technology things that are related to energy. So I would encourage, people on the line, because I have a lot of these people in my kind of Rolodex, and I'm sure everybody else does, but people that are looking for technologies to commercialize sometimes, as opposed to having a technology and trying to commercialize it. So I can kind of go both ways. Like if you've just exited something and you're looking for your next thing, there's a lot of opportunities to get involved that way as well.
That's great. So I think when we circulate the recording and slides for today's webinar, we'll include links to some of the information. You have an upcoming event in DC you might want to mention?
Yeah, sure. So two things that are on the calendar. One is September 26th is National Clean Energy Week Demo Day on the Hill. So 12 PEDC companies are demoing at big shindig at the Reserve Officers Association building up on Capitol Hill. Very cool. We're going to have everything from, I call it Frankenstein's monster of harvesters, which is called the Iron Goat. A lot of big hardware, cool stuff. So it's September 26th up on the Hill. And then we're about to announce, this is probably the first public discussion of it, we're going to have a DC versus New York City throwdown of the energy startups. And so it's going to be a home and home series where we do an event down here in DC on November 29th. It's hosted by Morgan Lewis over on Pennsylvania Avenue. We get 120, 130 people to these events, so you'll see probably 4 startups from the DC region, 4 coming out of New York, going head-to-head and battling it out for whatever the prize is going to be.
That's great. So we'll circulate information about that, the workshop you mentioned on the team building, your blog, the spreadsheet that you used today. But also, if people do want to get involved with PEDC, learn
Sure.
more about how to use you as a resource and join, where should they go?
Go to potentialenergydc.org, or just email me directly, and it's Dave at all of that.
Great.
All right.
Well, thank you so much for being our guest speaker. This has been really illuminating, and we appreciate having you. And thank you for everyone who dialed in today.
Yes.